Right. Let's just jump straight into this explainer. You know that feeling when you look at a company's financial report and it just feels like you're staring at a giant wall of random disconnected numbers? Yeah, you are definitely not alone. But today, we're going to change that. I want you to step into the shoes of a financial detective with me. We're going to learn exactly how to uncover the true underlying health of a company that's usually hiding right behind those dense textbook figures. By the end of this explainer, you won't just see raw data anymore. You'll actually see a story. Here's the quick rundown for our investigation today. Decoding financial statements, who actually needs this info, opening up the analyst's toolkit, and then we'll get into the math by creating comparative statements and common size statements.
All right, part one, decoding financial statements. What are we actually looking for here?
So before we can solve any case, we kind of need to know what we're talking about, right? Financial statement analysis is, at its core, the critical evaluation of financial info. We're essentially hunting for relationships between different data points. The whole goal? To figure out exactly where a business stands right now and where it's been in the past, so we can make some really solid predictions about where it's going. Basically, we're probing for the absolute strengths and the hidden weaknesses of an enterprise.
It actually helps to think of this whole process like a translation. First up, you've got analysis. This is where we simplify all that raw, messy financial data by methodically classifying it, organizing our clues. But then, and this is the absolutely crucial part, comes interpretation. That's where we explain what that simplified data actually means. Why does it matter? So the big takeaway here is that analysis is pretty much useless without interpretation, and, well, interpretation is literally impossible if you haven't done the analysis first. They go hand in hand. You need both to crack the case.
Moving right along to section 2. Who needs this information? The stakeholders who actually hired us.
It's a totally fair question. Who actually cares about these numbers enough to spend hours staring at them? The answer might actually surprise you, because it's definitely not just accountants sitting in a back room somewhere. The survival and success of a ton of different groups depend entirely on our investigative work. We've got a wildly diverse cast of characters. Everyone is looking at the exact same financial statement, but they're searching for totally different clues. If you're top management, your main motive is looking at overall resource allocation. But let's say you're a trades payable, basically a supplier. Your only question is, hey, does this company have the short-term liquidity to pay my invoice next week? Meanwhile, a long-term lender, like a bank, they couldn't care less about next week. Their motive is long-term solvency and capital structure. Can this company survive for the next 10 years? And get this, even labor unions use these statements. They comb through the numbers to see if a company can legitimately afford a wage hike without going bankrupt. Different motives, same exact crime scene. Okay, section 3, the analyst's toolkit. Basically, the magnifying glasses of finance. So we've got two main tools we're going to master today. First up are comparative statements, which you'll often hear called horizontal analysis. Picture a timeline. We are comparing a firm's financial performance against its own past performance over a specific period. Did revenue go up since last year? Did expenses drop? You're looking left to right. Then we have common size statements, or vertical analysis. This is when you look top to bottom within just one single time period. You take every item and state it as a percentage of one big aggregate base, like showing every single expense as a piece of the total revenue pie. It's a brilliant way to understand a business's internal proportions. Which brings us to section 4, creating comparative statements, tracking those changes over time. Our source material lays out this flawless 3-step preparation process to put this together. Step 1, just list out the absolute figures for your 2 years side by side in rupees. Super simple. Step 2, find the absolute change. Literally just subtract year 1 from year 2. Did the number go up or down, and by exactly how much? Step 3, calculate the percentage change. You take that absolute difference from step 2, divide it by your base year, so the first year, and multiply it by 100. Bam! You've just turned a raw, boring number into a measurable trend. Let's actually open up a file and see how this works in the real world. We've got a case study here involving a company called Amric Limited. We're going to compare their balance sheet from March 2016 to March 2017 and run our 3 steps. Okay, check out that first row. Share capital jumped from 15 lakhs in 2016 to 20 lakhs in 2017. Step 2, that's an absolute change of a positive 5 lakhs. Step 3, 5 lakhs divided by that base of 15 lakhs gives us a 33.33% increase. Pretty solid, but look right below it at reserve and surplus.
It actually dropped from 14 lakhs down to 13 lakhs. So the absolute change is negative 1 lakh, which translates to a negative 7.14% drop. Just by doing this horizontal analysis, it becomes incredibly clear exactly where capital is flowing in and out of Amrit Limited over time.
All right, Section 5. Creating common size statements. The component percentage approach. Now, the absolute secret to vertical analysis is setting what we call a common base to equal exactly 100. Think of it as our anchor. If we're looking at a profit and loss statement, our anchor, our 100 base, is revenue from operations. If we're on a balance sheet, the anchor is total assets or total liabilities. Once that base is locked in at 100, we measure every single other item as a percentage of that exact anchor. It honestly makes figuring out proportions just incredibly easy. Let's set up another quick illustration here. This time, we're stepping away from the balance sheet and we're going to extract the story out of an income statement, setting our revenue to 100. Pay close attention, because the narrative hiding in these numbers is actually kind of wild. Okay, look at the hidden story here. If you just check the absolute numbers first, revenue from operations actually dropped. It went from 25 lakhs down to 20 lakhs. Honestly, if you only looked at the top line, you'd probably think the company was in major trouble. But look at the bottom line. Profit after tax actually went up from 12.6 lakhs to 13.6 lakhs. So, how on earth does revenue fall but profit goes up? Well, our vertical percentage analysis gives us the smoking gun. By setting revenue to 100%, we can clearly see that employee benefits used to eat up 33% of the revenue. The next year, it only took up 22.5%. They drastically slashed employee expenses. So yeah, absolute revenue dropped, but profitability skyrocketed to 68% because they cut massive internal costs. See? That is the power of analysis meeting interpretation. And that basically wraps up our investigation for this explainer. We've defined our tools, we figured out who the stakeholders are, and we ran the math on both the horizontal and vertical axes. So here's the big question to leave you with. The next time you're staring at an earnings report or a balance sheet, what are you going to do? Are you just going to let your eyes glaze over at a wall of meaningless numbers? Or are you going to pull out your magnifying glass, set a common base, calculate those percentage changes, and translate the true story hiding in plain sight? Something to think about. Thanks for joining me on this explainer, detectives, and keep analyzing.